Hello, everyone. Welcome to the market update here for Tuesday, September the 27th. If you have any questions during the week or any questions I don't get to in the live class, sometimes that happens when we run out of time, you email those to me. You can send those to jerry@traderspro.com. I'll be happy to answer those for you. Lots to talk about today, as you can imagine. There's really some critical things that are going on, and the way things are shaping up, we're going to get a huge move. The question is just which direction is that going to be in? I can tell you, just to summarize right now, that the market is in a position right now where it's setting up for a rip your face off type of a rally. However, I keep talking about this panic sell-off, and we need to see a panic sell-off before the market bottom is in. And this is a situation right here where so many people are expecting this sharp rally to take place because we're really oversold. I'm going to show you just how oversold we are. But this is a situation that can create that panic. And the reason why I know that is because that's what I was feeling today. In the market open, it looked like it was going to take off. I personally had this feeling like, here we go, we're going to rally. And I'll show you when I get to the charts here, I'll show you the context of how all this could play out. Because ultimately, I still think we're heading lower. It's just a matter of when. And that could be that's the tough part, is knowing when and you know, because you can still get a panic sell-off after a sharp bear market rally, which is what I think the rally would be, is just a quick oversold bounce. But I could also feel as the market started to slide back down today, I started to feel that fear, like, uh-oh, that's not good, and this could get ugly. And the VIX started to spike up, and it's getting real close to 40, and 40 is, I told you, that minimum area that I would expect to really show panic in the market. You know, you might, if you've been watching CNBC, you might have heard some people coming on saying that some of these recent sell-offs have been panic sell-offs. They don't know what they're talking about, because the numbers that you look at, or the indicators you look at that show that panic just haven't been there. And I've been through a lot of panic sell-offs, so I know what the feeling is like, and that feeling is, holy crap, you know, this is bad. And that's what I started to feel this morning when we reversed and started to move lower. And so that's how I know that I'm not the only one feeling that a lot of other traders out there are looking at the same thing I'm looking at and starting to feel the same way. Now, again, I'm not panicky yet. Well, mostly because I'm not in a large long position as some other traders are, mostly on the sidelines. But that still doesn't mean that you can't start to feel that energy of, man, this is getting pretty ugly or pretty bad, or could get pretty ugly or pretty bad. So I'll walk you through that when we get to the charts here in just a second. But I want to start off with the direction alerts, because they are showing an extended market, an oversold market. You have momentum into that extreme range. Now, again, we could get all the way to the far left side of that. So if the market is going to have that flush out move, a lot of times these flush out moves happen because of the fact that everyone says, oh, the market's oversold, it's got to rally from here, and then it doesn't, and it has a big move down. So those big flush moves can happen in these conditions, but in most cases, when you get into these extreme ranges, you're looking for some sort of counter trend move or some sort of rally off of that. In a big uptrend, you get these big, deep pullbacks that can get you into that extreme range, and usually that tells you when you're getting ready to rip again and take off. But in the downtrend, it could be that you're near these lows down here, and all that rally could be is just another counter trend bounce before going lower. And that's what we've seen a lot of these. When it gets down to this levels, it'll bounce a little bit and then it'll head back down. And that's all these indicators are telling you, are extreme overbought or oversold. But we're in that extreme rate for momentum. We're at the left side there for breadth. And we're finally seeing the sentiment indicator come off that extreme range. It finally moved into the high range here. Now, if we get that move above 40 on the VIX, the thing about sentiment is it tends to you don't see long periods of elevated fear. It tends to be very quick. So what I'd expect here is that if we get a really big move down, a really big spike in the VIX, for instance, you see the sentiment indicator quickly move down into this. It's been stubbornly in this high range, but when it takes off and if fear spikes, you'll see this move quickly over here to the left side and move into that fear range. It won't take much to get it down into these levels, whereas it seems like it's taken a long time just to get out of the extreme complacency box. But it should move pretty quickly. But we're starting to see that movement there, and like I said, it's still showing though that well, in this case, it's showing there's enough fear there that when you add it to the extreme levels on the breadth and the momentum that we're dealing with a near-term oversold market condition. You look at the buy-sell ratios, very extreme. We were talking about how these were extreme here, but they could still go lower, and they did. Now we're even above the extremes from back in the summer. Very, very oversold with, and we're going to see it here just how bad that is. It's about as extreme as you can get. We'll look at the indexes here, box here in just a second. Sentiment curve or sentiment indicator here is close to that extreme, the buy extreme down here. Not quite yet there, but that would take much selling to get it to that point pretty quickly. But let's look at the index tab right here, because this is something that we've been looking at. This is something I don't look at all the time, but you do want to pay attention when the market starts to get to extremes. Was moving up for several days in a row. In this case, been moving down for several days in a row. This is about as extreme as those buy-sell ratios can get. I mean, look at the Russell 3000. This is taking into account almost every stock that's really large enough to really trade on a regular basis. There's only 21 of those 3,000 stocks that have a buy signal. Over 1,700 of them have sell signals. Now, can it become even more extreme? Yes, more of these holds can move to sells. That can happen, and that will happen if we break this support level and have that panic sell-off. But this is screaming overdone to the downside. This is about as extreme as it gets. So the point, what this is showing me is that, the market is saying it's getting ready to rally. You don't want to be entering new short positions in this type of condition because it's extreme. That there is a chance for a downside, but if you haven't made money on the short side on this drop already, then what you want to do is just go to cash. You want to wait for that flush up to take place, and be ready to look for opportunities to jump back in when the trend starts to turn again. But this is really a dangerous condition because, like I said in the open, we're going to get a big move here in a short period of time. Whether that's going to be up or down, that's the big question. And we're extreme enough to the downside to indicate we could get that, what they call it, kind of that face ripping rally where all the shorts get squeezed very quickly. Or, like I said, we get this panic sell-off where everyone just starts freaking out, like, I can't believe we're heading lower here. So let's take a look at the individual charts here just a second. Question: when do I get in and out of an inverse ETF? How much of an inverse ETF would you buy relative to your bullish position? Depends on if you're it depends on what the market conditions are. As you notice, what I'm trying to do with my long positions, I'm trying to be in them for a longer period of time. I'm expecting these stocks to go up over weeks. But I don't want to just jump in and out of those as well. So what I'm trying to do is let those trends develop, be patient with those trades. But if I see a bearish candle, it looks like the market's going to drop over the next 2 days or so. Doesn't mean my stock will drop, but if the market's going to drop, I want to protect myself in case that stock drops as well. So I'll jump in and I'll buy the SOXS or the SARK or the SQQQ we've been using as well. And all I'm trying to do is just really hedge the loss there. If we can make some extra money with it, that's great. The only time I've really only gotten into inverse ETFs is when I don't like any of the long positions, and so I haven't had long positions, and the market just is screaming that it's going to drop. Then I'll just have the inverse ETFs. But they're very short term. I'm using them very short term, and it's usually just based off of the candle that I'm seeing that day and whether that candle is suggesting that the market could rally the next day or drop the next day. If it looks like it's going to rally the next day, then I'll get out of those inverse ETFs. No reason to stay in them. But if you don't know how to read the price action each day and read the candle, then you probably just want to be out mostly in cash and mostly on the sidelines then. And I'm trying to kind of show you how to kind of use those inverse ETFs. I just can't do it on a daily basis. We have 2 classes a week to kind of talk about it, and I might be jumping in and out of them more often than that. So the key is to learn how to read the price action, read those candles. There's a lot of trainings in that on YouTube on the Traders Pro page. Related to reading those candle I cover almost every candle pattern there is, at least in the major ones. And if you get that stuff down really well, you'll be able to read the price action each day a little bit better. But like I said, that's not usual. When we get to a more sustained uptrend, we're not going to use inverse ETFs very often. So it's kind of a unique situation right now that we're in, the way I'm using them. All right, let's get to the charts here. And let's go through a couple of scenarios. Yeah, we're starting to break the support. So you can see what was happening today. So what we had is we had the market dropped on Friday, and the big drop on Friday came back and had a what we call a bullish. It's a bullish hammer formation, although it's not a strong hammer formation because you usually like to see it close higher than the open. Here's where it opened up here, and here's where it closed. So it just basically came off the lows of the day. Now, when that happens in a hammer formation, is that very often you'll retest the lows again. Doesn't mean you'll drop below the lows, but you'll retest those lows, and that's kind of what we did yesterday. We rallied up, came down, and we kind of retested the lows. We didn't go any lower than that Friday low, which was actually, that's usually showing a sign of selling exhaustion, that the selling is kind of done or could be done. And then we gapped up today and it looked like we were taking off a little bit early. We started to move up near the highs of the day right after we opened. And that's where I thought you'd get this really sharp rally. This is kind of what I was expecting, where it's a very sharp rally over 4 days right there. But all it was setting up for another move down. It was a short covering rally. It happens in fact, in this case, I was thinking that this type of move could happen all in 1 day or maybe even 2 days, where you have just these 2 massive up days. By the way, that's not uncommon. Some of the biggest up days in history have been during bear trends or bear markets. A big, huge up day is not the strongest signal that the market is going higher and that it's time to jump in. What you really want to see when the trend is up and the risk of more downside is lessening, is when you're getting consecutive up days, but they're smaller up days. It's more gradual buying that's taking place. And that's a better, so you're not getting these wild swings back and forth. You're just kind of getting just a steady grind higher. That's a more bullish type behavior in the market when that takes place. When you're getting really volatile moves up and down, that tends to happen in bearish trends or bear markets. So anyway, it looked like it was acting bullish, and then bam, it started to drop. And now, if it holds right here, and that's kind of going to be the key, and we're right at the lows. I mean, we're a little bit below the lows from June. And the key is going to be, do we close below those lows? Because I think that's what the market's looking at, is that's going to be the headline, is we close below the June lows today. If we do that today, we hadn't done that in these previous couple of days. We got close to it, but we didn't close below it. In fact, we might have even traded below it on Friday. I can't remember if we traded below it. I don't think we quite got below that low. Or I know we did on the SPX, but we didn't on the SPY. That's what I remember. I do remember on the SPX we did trade just barely below that June low, but we didn't close below it. So that today's close is probably going to really be a signal as to what happens next, because I could see the market really freaking out tomorrow if it closes below that low. Definitely a possibility we could get that. Now, what are the scenarios here then that are playing out? Well, let's go to a long-term chart, because it's the most obvious one that is kind of playing out. This move down right here, this first move down right here, that's either wave A. Well, that's kind of what we're looking at. That's wave A. The question right now is this wave B? And then are we in wave C? If we get that panic sell-off, I don't think the market needs to go that much lower to bottom. Like I said, if it breaks these lows, that VIX is going to spike above 40. I can almost guarantee that. And that's kind of the minimum that we're looking for at market bottom, is to get that VIX above 40, hit new lows. And if you get that combination, we're probably getting pretty close. We're probably more likely to be getting pretty close to a market bottom at that point. So the question would be then, is this, are we going to get that panic sell off? And this is wave C right here. And then we start to steadily move higher, or start to, that bottoming process where we start reversing back into a longer term uptrend. The other possibility, though, and it's the way that some of these ABC patterns can play out. And that's the thing, just understanding ABC patterns, it still can't tell you exactly what's going to happen next. You're going to have these periods of indecision where different scenarios could play out. And like I've said many times, if you're thinking there's anything you're going to learn in the market that's going to tell you exactly what the market's going to do, you're going to be disappointed. You just have to get that mindset out of your head, because you're going to be miserable, or you're going to be spending tons of money chasing systems and gurus and reading all these books that you think are going to tell you, not that reading books is bad or listening to people is bad, but if you're listening to them with the intent that they're going to tell you or teach you something that's going to allow you to never be wrong again, you're going to be disappointed. You're going to probably waste a lot of money in your lifetime trying to chase it, is what I'm trying to say. You can't. So what you do is you embrace that. There's going to be that uncertainty. I'm not going to get beyond that uncertainty. So let's look at the different scenarios. Let's look at how to manage the different scenarios. And I use the sports analogies all the time, but I can never know exactly what play the other team's going to run in a football game. I can never know exactly, unless I know exactly I can hear their play call or something, but without cheating, I can't know exactly what they're going to do. Now, that doesn't mean I throw up my hands and say, I'm not even going to compete with you. No, I do my work. I study. I look at their tendencies and their formations, what they tend to run, what plays they run off of those formations. And I say, if they do this, then I'm going to do that. I'm prepared to move whichever direction I need to move in when I see a reason to move in that direction. And that's really what I'm trying to teach in these classes and in the training videos and all that stuff, is how to be prepared for anything. And so the other possibility here is that this could still be wave A right here, but this first move up could be wave A of this wave B of another ABC pattern. So that's wave A of B, B of B, and then we get a rip roaring rally up into here, which is wave C, and that completes that wave B, and then we get wave C down. Now, there's a couple reasons why I think, well, boy, the way things are behaving today, though, see, if we really start cutting loose from this low right here, that could answer it right there, that we're in that wave C. But this presents that other alternative where we get this sharp rally back up. It may even look like, hey, we're done. We've hit that low. There's probably going to be people that say, hey, we had our panic sell-off, even though the VIX didn't get above 40. If it rallies right from here, it's not above 40 yet. And then everyone thinks that it's over, and now they're chasing. They're starting to buy because they think they're afraid we're at a bottom and they're missing it because it's moving so quickly. And it could just be that wave B, and then you get wave C, and this is where you get that this is where people really start to lose hope because they're like, okay, I thought for sure we were done, and now it's like the same thing. I thought we were done here, we went lower. I thought we were done here, we went lower. I thought we were done here, and we're not, and that creates that hopelessness that usually is what you feel like at a market bottom. It's like, how far is this thing going to drop? When is this going to end? Now, we got a little bit of that right now. We're starting to feel that a little bit right here, which we should, because we're at a previous low right here. We should start to feel like, when is this going to stop, or how much lower we're going to go? But we definitely would have that there if we break right here and drop. But this is the other scenario. And this rally, at least the first part of that rally, would be really sharp because all those people that are short the market and betting on it going lower, and there's a lot of people that think the market could go lower from here. Now they're forced to cover that short position. They have to buy to cover. That on top of people thinking that we bottomed out and they're buying stocks at this point. That's what can really create those big rally days. So, and again, I go back to look at the signals that we just went over. We're extremely oversold. We have far more sells than buys in the indexes. We're set up right here for a bounce or a rally, but there again, that's what's tough right now. Is it could go either way. Now the safe thing to do is either be hedged like we are in our portfolio. Whatever way it goes, we'll make money, or we'll at least survive, or just be out, stay out, and try not to. Because again, if you're on the wrong side of the big move, you can get hurt really bad in these types of conditions. And this is usually where I would tell people that don't have a lot of experience, don't know what they're looking for, don't know how to recognize this stuff. It's a good time to be out. And don't feel like you're missing out. The market is always going to give you opportunities to make money. You don't have to get in at the bottoms or out at the tops in order to make money. You have to have that bus stop mentality that I teach all the time. Can you imagine running after the bus, screaming and yelling like you're never going to see that bus again? No, everyone look at you like you're stupid. You're like, go sit down at the bench. It's got a nice little bench there. Some of the benches have a nice covering to protect you from the sun. And half hour later, another bus is going to come around. Okay, just wait for the next bus. You have to have that same mentality in the markets. We're not missing out on anything. We don't have to get in, or this is it. This is our one chance in a lifetime. No, and if that one chance in a lifetime is over a coin flip, that's even worse. It's like, okay, heads or tails, and if I'm wrong, I'm broke. Don't ever put yourself in that position. The key to making money in the markets is you got to stay in the markets, whatever you can do to stay in the markets. And part of that for some of you is not being in the market when conditions are we're going to get a huge move one way or the other. And if you guess wrong, you're going to get hurt really bad. No, you don't want to be putting yourself in that position. This will play out. We'll have a better idea either by Thursday or next week. We'll have a better idea of which direction we're going in, because we're not likely to stay right here for very long. In fact, we may have a signal by the end of the day if we really start selling off into the close. That could happen. So again, either this is wave A, wave B, and we're in that wave C. We're gonna finish this out, or it's going to extend. Now, another reason why I think it could extend is because I see the market being in this chaotic state for another several months, maybe even all throughout the next year. And typically, the market is usually trading ahead of the conditions, meaning that it should start to rally when the economic conditions are still getting worse. But since I don't expect them to get better or to see the peak worse in the economy until in the next year, at least that's kind of how I'm looking at it. I could be wrong and have to change that point of view, but that would set up to where we could rally for a few weeks and then get that bigger drop, and so this could take a couple months to complete this, and then you're going into next year where the market could bottom and start to rally again. I don't know. That's just another thing to kind of consider. And October tends to be more of a bullish. Well, October tends to be a very volatile month. At the end of October and then going into November tends to be a little bit more of a bullish, a little bit more skewed to the bullish side. November tends to be a bullish month. December tends to be a bullish month. But again, you never want to base trades just on seasonality alone. But anyway, that's where we're at. Get back to the 6-month chart. Yeah, we're still just right in that same area there. We'll keep an eye on this at the end of the day to see what it looks like. All the other indexes are pretty much showing the same thing. Although the Dow, you can see, is below. It is clearly below that June low. NASDAQ is up above it still. So again, we're getting a little bit of conflicting with signals with the different indexes. Russell 2000 is right at it, hasn't dropped below that June low yet. And all these, again, the indexes are in the extreme reversal risk, the oversold range too. Now, the bond market has been the big front and center news item each day. It continues to go lower. I think at this point, what you're looking for to help with the market rally, you're looking for two things. You're looking for the bond market to rally, and you're looking for the dollar to weaken. I think the strong dollar is really making it tough for the market to go higher. And that's another thing, is the dollar looked like it was pulling back earlier today, and that's another reason why I thought we could start to rip higher earlier in the day, and then it reversed. It went and ended up going higher again. But it's looking exhaustive, though. That's the thing. I could see within a couple of days too, if we don't really break and just have that panic sell off here, that I could really see where we can get that rip and rally happening pretty quickly here. And your extreme levels are just extreme oversold on bonds. I mean, they're due to bounce and rally up, but haven't been able to do so yet. So the trend in bonds is still down. We'll keep an eye on that, though, because like I said, we're going to need to see a nice sharp rally in bonds in order to get a rally in the markets, I think. Or at least show that they're not going any lower, maybe start moving sideways, or at least trying to rally a little bit. I think we need to kind of see that for the markets to have a little bit of a sharp rally. Gold is in an extreme. Now, this was earlier in the day. This was up. It looked like a bullish inside day. Here's where we opened. It looked like we had a bullish inside day. That could still take place if gold can rally above its opening price today and close above its opening price. That would be a bullish inside day. You have a big down day, and then you have an inside up day. But there again, would that just be a bounce for another move down? The trend is still clearly down in gold. I think what's really keeping the commodity prices down is the relationship with the dollar. Now, commodities and the dollar don't always move in opposite directions, but these commodities, all these commodities are priced in dollars, and so they tend to move inversely. And the dollar is just ripping higher still, and it's hard for these commodities to rally when that's happening. And although gold is an inflation hedge, and everyone's like, why isn't gold rallying? Well, because the dollar is just is rallying so extreme that it's very difficult for gold to find any support and to rally significantly. So still trending down. You got lower highs, lower lows. It's still acting like a downtrend. So what you're going to look for if you're looking at any move in gold is you break that. So this was the last lower high before we went to a lower low. It's also near a support level back in here. So you're going to take a line across there and say, if I get above that, then I could be in a trend reversal. That would at least be the minimum of a trend, especially if you moved in an impulsive way, a sharp way off the bottoms up above this high. That would be an early signal of a possible trend reversal in gold. But until then, we're still in a downtrend. You would expect that trend would continue, but you don't want to short gold because we're in an extreme range. We're extremely oversold. You don't want to start a short position. Not that a lot of you are shorting out there, but you don't want to bet on gold going down at this point because it's in an extreme range where it should start to rally here or reverse, at least just to alleviate that oversold condition. Even if it's just a rally for a few days, like right in here, just to alleviate that oversold condition, then it continues to trend down. But you're in a spot right here where it should either move sideways to alleviate it or rally a little bit to alleviate that oversold condition. Oil, again, you're oversold extreme. We had that really sharp move down yesterday, but we had a little bit of a bullish inside day today. This is something I've been watching. And I got into a position on SPWR last week. I can't remember if I did that in the Thursday class. I think I did. We'll look at that here in a second. We look at the positions, but there's been, particularly in alternative energy, there's been a lot of bullish looking patterns. I think if the market can rally, these are going to take off first. I think these are going to rally pretty strong at first. But a lot of these oil stocks are beaten down a little bit. Now, again, this could just be signaling a bounce within the downtrend. I'm not suggesting that oil is going to bottom right here and take off. I mean, we could look at a longer term chart. You have, this could be wave A, wave B, wave C, and we could be close to being done correcting that move. But, that's the thing is, when is wave C done? It could keep dropping and still be wave C. So I don't see any strong signal yet that could be done. Although if that finishes as a bullish inside day, that could be at least one signal that maybe you get a little bit of a rally off in oil. But I don't know what that's going to look like at the end of the day. That's just what we're seeing right now. We've had this happen in class before where we've seen a pattern, and then by the time we're done with class or that hour after we're done with class, that candle pattern looks different by the end of the day. Because if this were to come down and close lower than where it opened, it would not be a bullish inside day. It'd be a kind of a bear. It'd be more of a bearish exhaust, it's kind of selling exhaustion type day if it were to do that, which is still kind of a bullish sign, but it's not a very strong reversal sign. It definitely need confirmation of that. And this is a big focus right here, is the dollar. You're going to want to keep an eye on this. Now, by the way, some of these charts, as you'll notice, there are days where I don't really put a huge emphasis on the dollar. I'm not going to spend time talking about the dollar. You have to pay attention to what the market is focusing on, and it's real easy to do that. Just turn on CNBC. You don't have to listen to what people's opinions are, but what are they talking about? What are they looking at? And right now you're hearing people talk about the bond market. They're talking about the dollar. So that's what we're going to focus on. Is do we see changes in that trend? We're definitely at extreme levels. We're at the far right side of the extreme range. You're about as overbought as you can get. And then that's what was interesting today, because here's where we opened right here, and we were trading lower. It looked like a bearish inside day, just the opposite of that oil chart, which is what you would expect, because these tend to trade inversely, right? Well, what happened is that as these things will do during the day, is it started, instead of holding that or dropping lower to show some sort of bearish reversal, it started to push higher again, moved above its opening price, and then moved to a new high. Now it's barely at a new high, and the fact that it opened lower and is barely moving to a new high, this is showing a little bit of exhaustion. You're already extremely overbought. You're having trouble moving a little bit higher. But again, I don't see anything that's saying a drop is imminent off of this. It's just showing some buying exhaustion. There could, and that could change. There could be some news item that comes out that out of nowhere that is bullish for the dollar, and the dollar just surges higher again. You can get even more overbought. That's why these extremes should not be traded by themselves. But you just need to know that you're in a stretched market. So you definitely don't want to be going out and buying the dollar right here. But I don't see anything that would indicate you want to start shorting it either. Not that not that there's a huge part of the audience here that's short stocks, but you shouldn't want any sort of bearish bet on it just yet, with the way it's still behaving. But this kind of all ties into what I opened the class with, where all of this is showing we're getting ready for something significant, a big move, and nothing's really making it clear which direction yet, and that's what's tough. Unless you're guessing right here, and we don't want to be guessing. The VIX. Now, this isn't going to show the because remember, this is the VIXY. This is the ETF that allows you to trade the VIX. Not that you should be trading the VIX. It's not a very good trading instrument. But I am going to bring in another chart so you can see. I'm going to bring in a chart of the VIX. You can get this on any charting service. Most charting services just type in VIX. Now you can't trade the VIX by itself, the VIX indicator by itself, but there are these other trading instruments, and that's we don't have VIX on Traders Pro because we have only the tradable instruments on Traders Pro. Those are the only things that we have data feeds for that service. So, but the reason why I'm bringing this up on another charting service is all we've done on the VIX is just get up to these extreme levels. This is where we were back in June. We haven't been able to get above. We did get above it a little bit right here. We got pretty close back there in February. We got close to. But 40 that's the level of freaking out. That is the panic area. At a minimum, we could go higher than that. But I want to see the market get above 40 before I even want to talk about a bottom possibly being in place. Now, what happened here today, and this is one of the reasons why I thought we were going to rally too, is we opened right here on the. Now, let me widen this out so we can see this in a little more detail. We opened and immediately rallied up a little bit. It looked like even with the market was taking off, it was rallying up, and then it came all the way down, and it was actually trading lower. And at that point was when I thought this is where we can see the market take off. The VIX is moving down, is moving in the opposite direction. And then when it dropped, it surged all the way up to 34 here at the highs. It didn't take much to get from down here around 31, 32 up to 34. If we break the support, we're going to get above 40 pretty quickly, pretty easily. But that's something to just be aware of, keep an eye on. But again, like I said, we could also come back down. Market could rally a little bit, come back down, and then we spike up later. Not saying that the panic has to happen here, but this is a spot, like I said, where you can feel the tension in the market right now that it really could get ugly if it breaks this area here. All right. But this is a good chart to show you though why you don't want to trade these instruments. On these rally, when the VIX is spiked a little bit, the VIXY moves up a little bit, but overall it just keeps dropping. It just is in this relentless drop. Notice how the VIX were already the VIX indicator. We're already right up here with these May and June highs. We're not even near that on the VIXY, and so it's just and the same thing can happen when you're trading even like the TQQQ or the SQQQ or the SSO, some of these leveraged ETFs. That's why you don't hold them for the long term, because over the long term, it just won't work. You can use it for very short term trades, and even then, I wouldn't recommend doing any sort of VIXY trade. Just trade calls or puts on the S&P. If it looks like the VIX is going to spike, buy puts on the S&P or the SPY. If it looks like the VIX looks like it's going to drop, buy calls on the SPY. You'll have much more consistent gains doing it that way than trying to trade the VIX. SMH, again, all these charts are trying to hold that June, in this case July low. This had a little bit lower low in July. It didn't bottom in June, it bottomed in July. But it's trying to hold that same thing. If it breaks it, all these things would break it at the same time, and that's why this is a critical spot right here. Everyone's kind of focused on this: is it going to hold? Is it going to break? They're extreme oversold. So SMH isn't in the extreme range yet, but you look at the transports, they're the far left side of the extreme reversal risk. They have moved below the June lows. We mentioned that last week, that we felt like the transports were showing a much more bearish direction than the Dow Industrials at that time. But it's already broken below that. So is it a leading indicator? Does that mean that we're going to see the rest of the markets kind of follow that? And by the way, I don't want to get so focused. Well, let me go. Bitcoin tried to rally today. Here's where it opened. It's all the way back down. This is that key support for Bitcoin. I think Bitcoin ultimately is going to go lower, but it could bounce. It would bounce if the market bounced as well. But let's go back to the SPY. Oh, I need to look at the HYG as well, but SPY real quick. There is a scenario too. Okay, you have to realize, and this is where it gets very difficult, because this is where the games come in, and you're playing games against seasoned professionals. It's like trying to play one-on-one basketball with LeBron James. It's like, could you maybe get a lucky shot off and make a basket? Yeah, you probably could, but are you going to win the game? No, you're not. Probably not going to win the game. So you got to be careful trying to play the game with these professionals. But everyone's the whole world that knows how to read a chart is looking at the same area, and even those that don't know how to read a chart are looking at the same area too, because everyone's looking at it. You're not unique today in class. I'm not anyone special showing you this. Okay, everyone is aware of this. Okay, so sometimes when we hear things or learn things, we think that we're the only ones that are seeing it. It's like someone sees breaking news on CNBC. Just because you're the only one in your house doesn't mean you're the only one hearing that news and that you're an insider, right? No, millions of other people have heard the exact same breaking news and are probably going to be doing the exact same thing you are, which is rush to your computer to make a trade. Okay, so there are professionals that know this, and so the game that could happen here is they could push the market lower into the close or something like that, break that support area. Everyone all day, all evening long will be talking about how we closed below the June lows and how bad that is and how negative that is. And then rip the market higher the next few days, where everyone's jumping in because they know it's safe now to short the market, because everyone talked about how bearish that is. And it's giving them a chance because we barely closed below there. So they have a chance to get in maybe tomorrow or something like that. And then it just reverses. So sometimes that's what happens. You'll see stocks will barely break below a support area. They drop below the support area right here, and then boom, it takes off. You know, this is designed to try to shake people out, or in this case, make people feel very confident that they're on the right side of the trade. Remember, I told you it's very dangerous to short right here, but this is exactly the spot where people think it's safe to short right there, because it's breaking that June low, so it's got to mean we're going lower. And I'll tell you, there's a phrase that I use a lot and I didn't invent the phrase, but I can't remember where I heard it, so I can't give them proper credit for it. But the phrase is, when it feels safe to get in, it usually isn't. And if that's something you should write down and make sure you're aware of, because if you're waiting to get into a trade until you feel like it's so safe, there's no way I'm going to lose money, that's usually the wrong time to be getting in, whether it's long or short. When it feels like you're almost guaranteed to get the move you're expecting, when it feels like everything's lining up and you feel so confident in the trade, that's usually not a good thing. And that's why I get back to the fact you've got to embrace uncertainty. You got to embrace the unknown, because the best time to get into trades is when you get a few of these clues and it looks like you're getting something, but it doesn't feel like it's got to happen or it's guaranteed to happen. Whenever I feel like it's guaranteed to happen and everyone agrees with me and it looks like I'm smart along with everyone else, there's a little voice in me that suddenly says, uh-oh. When it feels safe to get in, it usually isn't. And I could see that happening here, where, because we're trading below this low, but we're not really crashing below it yet. Now, again, that can happen in the last hour here coming up. You have the VIX that we just looked at that's come off the highs there too. So just we'll see how that. Like I said, Thursday might be a better class as far as seeing where we're more likely to go at that point. But that just the fact that we've kind of been trading below this and we're not sliding yet. And again, and maybe it waits to the close to do that. But if it doesn't, then that rally is still on the table and especially if it rallies into the close. That could be the trigger for that the sharp rally that I talked about earlier that could take place, and it's probably more likely to take place. All right. Oh, I wanted to go back to HYG. This is another one too that again, early today, it was trading up here. It opened up here, and then it dropped. But this is one to pay attention to too, because the market's paying attention to it right now, and it's down. It's right down there at the lows. But this is actually a sign of we're in the extreme oversold range. If it holds right here, especially if it closes right in this area right here, this is a sign of it's not a strong bearish sign. It's actually a sign of selling exhaustion. You sold off right. Well, you sold off. Usually, you need context is important. You've already dropped quite a bit, and then we tried to rally right here, but we faded. But we're right at the lows of the previous day, and we're holding right there. That's telling me there's not a lot more sellers that are piling on. Now, sometimes you'll get selling exhaustion, and you still get one more move down, or you still get a move down. But this is often a signal that you're getting close to a drop, or at the end of the drop. And the same thing would be true in an uptrend when you see an upward move, kind of like we're seeing with the dollar. Although the dollar has kind of gone a little bit higher, but if it fades a little bit, if it closes about right here, you got kind of the same thing where it's gone up for several days in a row. It tried to go a little bit lower. It's tried to go higher here, but it can't really get too much above the previous day's high. That's showing it buying exhaustion right there. And again, it doesn't mean it's got to drop from that. I've seen these pauses where it looks like buying exhaustion, then it has another burst up. But usually it's signaling that you're getting close to a pullback. Now, it doesn't have to be a pullback. That's something to keep in mind with these. It could be to alleviate an overbought or oversold condition. The market could move sideways, or a stock could move sideways. We could see the dollar do just something like this, and it would alleviate that overbought condition a little bit. Okay, so and that would be a sign that's still of buying exhaustion. It's not dropping, it's just kind of moving sideways, and then maybe you get one more burst and then it reverses. So again, buying exhaustion or selling exhaustion is not a good trading. I don't want to trade that by itself. So going back to the HYG here, I wouldn't look at this and say, oh boy, I'm going to buy the HYG right here because this is showing selling exhaustion. No, what I would look for is, okay, it's showing the selling exhaustion. Do I get some confirmation of that? Does it start to move up sharply? Then that would be more of a signal that it could rally off of that. All right. So what's the bottom line here? Just what I said in the beginning. We're getting ready. It's market setting up for a big move. The question is it going to have a sharp rally, bear market rally that ends at some point, or do we break these lows and do we get that final sell-off? Part of me just wants to get the sell-off over with, and although I'm not suggesting that one sell-off will mark the bottom. There could be a bottoming process where you still have these bounce back rallies and move sideways, or maybe even goes lower. But that's just kind of a minimum to know that we're close. And once we know we're close, we're going to start getting prepared to deploy our capital, because we've got a lot of capital to deploy. I've got 82,000 in cash, and that's not including the 20,000 I could get out of my inverse ETFs on. I did get out of the SOXS. Oh no, not the SOX, the SQQQ. I got out of that Friday because I think it was Friday. Let me look at the chart here. Yeah, I got out on Friday because it looked like this could be a little bit of a hammer formation. And because if we were going to rip higher quickly, I didn't want to have all three of those inverse ETFs. And by keeping two, I at least knew that if we did drop, those two would help help with the other long positions. They would help. I may not make anything, or I may still lose money, but the whole point here is I'm just trying not to lose money. If I can make a little bit of money or I can remain break even, that's great. That's all I'm trying to do with these trades right now. But I'm going to hold those two. I'm not going to add. If we break, if it looks like we're going to break this low and like, let's say we start selling off into the close, it looks like we're going to break this low and we're seeing the VIX really start spiking up, I'll get back into the SQQQ. I wouldn't mind having 3 of those into the close there if I see that. But I'm so worried about this sharp rally that I may just keep it at the 2. I think that'll be enough to hedge right there. Again, we're kind of stuck at about 132,000 right here. We're just kind of in this range. Now, I don't know if I added Tesla. I can't remember when I added Tesla, but we'll look at that one. Like I said, a lot of these electric vehicle stocks, solar stocks, alternative energy type stocks are holding up pretty well and could really rally. So here's SARK. This is down a little bit. Well, we'll see. Unless if we rally off the lows today going into the close, I'll probably only keep one of these inverse ETFs, and it might just be the SOXS. We'll see. Let's put this in portfolio here. SPWR, I like this one. It looks like an ABC pattern right here, a little bit of a deep one. It had an ABC pattern right here, broke to a higher high. I think I've got my stop down below here to give a little bit of room. But this took off yesterday. It was all the way up here. Here's where it opened. It was all the way up here. So they faded a little bit. I think it's fading just because of everything else. So the market, the dollar, I think the dollar with all these energy stocks is going to be key. This was trading all the way up here until the dollar started surging. So if we get that dollar pullback, I think we're going to see this take off. So that's why I've given this a little bit of room. Got my stop down below here. NOC, this one drives me nuts. I had my stop below here. Remember, I got barely stopped out, and then it took off again. I got back in it up in here. We got this big breakout move, and then it reversed, and it's come all the way back down. I put my stop down below here to give it a little bit more room, and it seems to be working okay. It hasn't stopped me out yet, but it's because I'm bullish on these defense stocks. At some point, they're going to start taking off, and I'd like to be in them. I don't want to, but I also want to control risk. I don't want to just, I don't want to just hold it just because I think it's got to go up eventually. But this is showing some selling exhaustion here with these last couple of days. We'll see if that holds. Like I said, my stop's down below here. I'm still holding this. SOXS, that's down a little bit today too. But I need that as a hedge right now still. And then Tesla, you've got kind of the bowl-shaped move down here. You have this move up, and then this kind of move sideways right through here. I think I stop is down below here, so I'm close to getting stopped out. I'm hoping this holds because I think this is going to take off and have a big move if it can hold. But I don't want to, I'm not afraid of getting stopped out. And the whole point of this is if we do get that big sell-off move, I'll get stopped out of these trades. I can always get back in them again when we bottom. And the other inverse ETFs should help with those losses. We should offset those losses. And they've done a pretty good job with that lately. We've been kind of stuck, like I said, in this 132,000 range, but 131, 132, 133. It's just kind of been around there, but that's fine. We'll take that as long as we've got capital ready to go when this thing is all done. Let's look at a couple stocks here, and then I'll wrap things up. Again, I don't want to get into anything really right now. But if we do get a sharp rally, there's areas that I think could take off. And obviously at the top of the list, oil. I don't think we're going to rally unless the dollar is pulling back, which means that the commodity stocks should rally. And they've been the strong stocks throughout a lot of this. So these are kind of no-brainers to kind of consider. One of those, like I said, if I'm sticking with alternative, First Solar right here is a 97 strength rank. FSLR is a ticker symbol. Looks like it's completing a possible ABC pattern right here. Big run up right through here. And a lot of these stocks have just exploded. You could wait for it to go back to a buy signal, or wait for it to break out to new high as confirmation. Wait to see what the market does as confirmation. Those are all things you can consider. Definitely not saying just get in them just to get in them. And then another one in that group is, well, one that I'm already in. And now the strength rank on this has dropped a little bit, but it was right around, I think it was right around 90 when I got in, but it's at 88. But SPWR, I already showed you that one in the portfolio. But if this is one that I really like. If you're not in it yet on the portfolio or whatever, this is one that you want to consider. Now, you can wait for confirmation to get in. With I'm already in it, so I've got my stop in place But if you want to wait to get in, I think you could wait for confirmation and still do very well. I think it'd be smart to wait for confirmation. Does the market go either way? And if it does drop and I get stopped out, you didn't lose any money because you're not in it. And if it does rally, you might be getting in a little bit later, but you have a safer entry. It just makes a lot more sense right now if you waited for a little bit of confirmation. And then one under the medical sector. And I just saw the story on this one, so that's what's made it interesting to me. I like the chart, but if you go to medical and large cap pharma, Eli Lilly, LLY. Actually, all these are especially Johnson & Johnson and Eli Lilly look pretty good. But let's look at the longer term chart on this. So you're already in this longer uptrend right here. Kind of, it's held up pretty well during the market selling right here. But I don't know if you heard the news on this one. But they're supposed to be coming out with a weight loss drug that, and again, sometimes these things get hyped up, so I'll take it with a grain of salt, and I'll see it on the chart. But it did have a good burst when it first came out. But they're comparing it to the way that what is it? Hold on, let me switch this back over to candles and go to the 6-month chart. Hold on just a sec. Hold on just a second here. Sorry. All right, sorry about that. All right, so let me go back to well, you can see the day right here when the news came out, and they're comparing it to comparing it to what the effect that Viagra had on on the world, basically, helping people with ED. There's a lot of overweight people, and if there's the rumors are it can take off like 15 to 20 pounds or something. I don't know. Again, this is stuff I just saw a story on it where I looked at the chart and I looked at the potential of that. I know there's a lot of fat people in this country right now. That could be a big moneymaker for them. But I thought I'd throw that out there. I don't ever base a decision off of a news story or off of claims of something, especially with drugs, because they can, there can always be problems in the approval process. But the fact that this has held up pretty well, and a lot of these biotech stocks have held up very well during the market sell-off. They tend to be defensive stocks, and you throw on top of that a story that could be a catalyst for it to go higher, and a high strength rank, a 96 strength rank. I thought this is one that I'd kind of point out in class today. Now, again, I wouldn't just jump in it for that reason. What's obvious here is you could, what lines up with what I talked about today, is you could draw a trend line right through here. If it can, it's up today despite the market being down. So if it can break that trend line, or you could wait for it to go to a buy signal. And if it is going to be the next big moneymaker for Eli Lilly over a long period of time, there isn't a perfect. You don't have to have a perfect entry point to make money. And like I said, you definitely wouldn't want to get into it just to get into it just because of the story. But if you saw some confirmation on that, if the market looks like it could rally, and that'd be a key too, is if the market could rally, because this could go much lower if the market has a panic sell-off. This could be one that you might want to consider as a long-term type position or something like that. All right. Question: do we have access to my portfolio? I go over the portfolio here. Is just like I said, right now I'm doing a lot of trading just because we're in a bear market condition. You must be new, so I say this all the time, but if I got new people coming in, this could be beneficial to them. The choices in this type of market condition where you're waiting for a bottom and the market is clearly in a downtrend, and in this class, we're only looking for long positions we want to be long. We're not looking to short anything. We're not doing option trades in this platform here or anything like that. And so the main choice in these conditions is if you don't want to trade, is to be out. So I could have a class every day where we have 100% cash and I don't talk about anything because we're not doing anything until the bottom is in, and then what we look for is we have a process here. We look for high strength rank stocks, waiting for them to go from hold to buy, and we're looking to ride the trends as long as you can ride them. Usually we'll have a trailing stop. We'll use trailing stop techniques. A lot of those trade management techniques are covered in some of those trainings on YouTube. Go to YouTube. Go to the Traders Pro page. There's lots of trading videos that you can spend hours and hours going through, and that teach all the stuff I talk about in class as well. So that could be our class. Is every day I do a market update, and then we don't have any trade suggestions because we're not doing anything. I'd be boring. I wouldn't have anyone. Obviously, people are tuning in for something, some idea. And so what I'm doing right now is just doing, I'm still trying to get into, if I see a high strength ranked stock that has a good chart pattern, looks like it's in an uptrend, we can wait for it to go from hold to buy. We'll trade it. We're focusing on the top sectors as much as we can right now, because these are the sectors that are outperforming the market. But I'm also using these inverse ETFs to hedge. And so we're still long. And so, stocks like SARK and the SOXS, these are going to go up if the market goes down. And so it allows me to still be long. I don't have to be short, but it allows me to make money or to at least offset losses if the market drops. So this is a whole different type of environment right now that we're in. And we only have classes on Tuesdays and Thursdays. So sometimes I'll make these changes during the week, and Monday or Wednesday or Friday sometimes. So this is, you can mirror the portfolio and adjust it when we have these classes. Like I said, we'll pull it up during class to look at it. But the real technique where you're going to get the better ideas of trades that you'll want to be in for this type of system, this type of software, is going to be when the market bottoms. And then what's going to happen is we're going to start deploying a lot of this cash into these positions. We're going to be trailing the stops. And the boring part then is going to be that we're going to have all of our trades, we're going to have all our capital tied up. But even then, I'll still go over new trades that you could consider that follow this process or follow this system. So if you want to, in fact, I believe all the training videos are all on that YouTube channel. You could go back, if you want to see what a class is normally like, go back at least a year, maybe 2 years, or maybe a year and a half or so, about a year and a half maybe, and watch one of those classes. You'll see a better example of what the typical class is like, where I'll be pulling in tons of stocks that fit the criteria that I'm looking for, and then you have lots to choose from, and then I'll have a portfolio that I'm managing based off of that, those positions and things like that. So, but mostly the portfolio is just to show you an example of applying these principles and how they can work if you just, if you're patient and you just kind of let the software do the work. Do earnings have an effect on my decisions? Yeah, sometimes. Now, a lot of times it may be I don't know that the earnings are coming up, and if I do, I'll probably wait till after earnings to make a decision to get in, because you can get a very volatile move in either direction off of earnings, and sometimes the charts don't even give you an idea of what that move might be. But in a longer term, for a longer term position, you're not going to be as worried about earnings, because you can get a lot of volatility around earnings, but over time, you should still be trending upward, and if not, if you get a big move down off of earnings, you'll be stopping out, whether that's stopping out and taking your profits because you had a trailing stop, or stopping out because now the fundamentals have changed in that company and you should be out of that trade. Go move on to something else. But yeah, I'll if I know about it, sometimes like I said, I don't always check to see when earnings are before I get into a trade. But yeah, that usually if I am aware of it, I'll try to wait till after earnings to make that decision. All right, I got to run. Any other questions, please send those to jerry@traderspro.com, and I'll be happy to answer those for you. Have a great week. We'll see you on Thursday for the next market update. Bye now.